In terms of product mix, you need to think what is actually profitable for you. You don't need to offer the full range of products anymore. You can specialize on those that are profitable, which allows you to, on the other hand, take out certain services and products completely, which is a big gain in terms of efficiency, brings a lot of cost out. Talking about expenses, I think the main aspect here is really technology. Technology is a big driver in gaining efficiency, but also enables new business models. So it's really a virtuous circle we are talking here, but technology is something that needs to be much more actively embraced. We're talking about automation, digitalization, and most banks are still way behind the curve here. Capital in public markets usually follows a passive strategy without a particular conviction, but rather following an index. Private equity means concentrated ownership, and concentrated ownership from sector specialists that have deep insight into the industry, that have done repositionings of businesses, that effectively have the operational experience it takes to turn around a business. Is obviously a totally different ball game. The prime targets in the current environment are found in places and in institutions that haven't gone through this transformation or haven't gone far enough. And there are a lot of those institutions out there. This mainly refers to players that haven't brought in sufficient technology, where the technology gap is still pretty, vast, yeah, and therefore they haven't really made the most out of their financial resources effectively. The typical opportunities that you would look at, or that FSC looks at, are old-style, traditional, universal banks, regional banks very often. Spin-offs or subsidiaries from large banking groups, or undermanaged, underleveraged specialty lenders that still are grounded in the real economy, but haven't had that particular knowledge to bring them into a full swing in terms of repositioning their businesses.